All right, it's recording. So before I do anything, before I say anything, before I want to say anything on this video, just want to give a huge thank you to Alex Options. He's a guy that trades options. He trades the strat. Amazing dude. I think he is a very, very strong stratter, if that's what we call them, stratters, because they trade the strat. And I think he's an awesome guy. I think he's wonderful. And this is going to be his presentation. It's awesome, and I think it explains a lot. And this is something that I would like to use to kind of explain how I use the strat over here as well with you guys. Just giving you guys a full breakdown of that as well. So we'll go ahead and start off with the fundamentals. Z, can you just say something real quick for me to see if I can hear you?
Yep.
Yep.
You
All
guys
right.
hear
Cool.
me? Hello?
Cool.
Okay.
Cool. I'm just checking that my thing would be able to hear you, and that's it.
Mhm.
All right. Cool. So to get everything started, what is the strat? Now a lot of people are curious on what is the strat because it's called literally the strat. So everybody's like, what do you mean by the strat? It's a strategy that is based off of price action. Basically base trading method that is 100% objective. That the objectivity means that there is no guesswork when trading. This is beneficial because it allows you to remove all biases and only focus on what we know is occurring within the market at any given time. So what I mean by that is any given time, or what he means by any given time as well is any given time frame. You could use the 5 minute, you could use the 1 minute, you could use the 15 minute, you could use the hourly, you could use the 30 minute, monthly, weekly, whatever chart you want to use. There's no given time frame that you need to use to actually understand how the strat works. It's pretty much just a fundamental strategy that is not biased. You don't have to have a specific time frame that you're trading or time zone. You know how some people tell you like, oh, you have to trade from New York Open until 11, and then once 11 comes up, the volume slows down, so stop trading. Not actually true with the strat. You could find setups still. Just quality-wise, they're gonna be different, obviously, right? So that's that. Or like for example, the 15-minute orb. The 15-minute orb is the first 15-minute candlestick that opens up after each session. So we have 3 major sessions: Asia, New York, and London. Once one of those opens up, you draw out the 15-minute high and low, and you wait for a break. You go ahead and take entries off of the break or the retest of that level. So the way that goes is pretty much that's a biased strategy. It has a specific time frame and it has to work at that time, or if it doesn't, then that's that, right? So there's no guesswork with the strat. Now, table of contents. Ones and twos and threes, the only thing that can occur within any market or any type of market. Reversals, price can reverse in an infinite amount of ways. Price can continue in an infinite amount of ways. Continuations and broadening formations. Introducing broadening formations. What are those? We'll explain that. So now, ones and twos and threes, right? Price action cannot occur in any other way. There's no other way for price action to be explained other than just ones and twos and threes. That's it. Just the ones and twos and threes. That's the only things that can be explained. So what are the ones and twos and threes? A one labeled as a one as an inside bar, which is defined as a consolidation. There has not been a new high or low made, and pretty much the candle stays inside the previous candle's range. Does not break out the high, neither does it break out the low. It pretty much stays inside the range. What does that look like? So this is an example of an inside bar or a one, which is a candlestick right here. If you look at the previous candle and this inside bar does not break the previous candle's high or does not break the candle's low. So it stays inside, and this gives us that this is a period of consolidation. And you will understand why we use these here in a sec. We'll explain that. I can't click my minus. Okay, there you go. No, all right. So labeled as a two, labeled as a two bar that took out the previous high or low. This is the bar we look to be trading as it is a directional move. So this can give us a direction, right? This can give us whether it's price continuing in an uptrend, for example, in this scenario, where price was an inside bar and it broke to the top side, but it did not break the low of the inside bar, right? Notice how the low is right here of the inside bar. This candle did not come break this and that. It only broke the top. So this gives us that price is currently in a uptrend and just pushing up, right? Pretty common sense, self-explanatory. Again, the strat is very simple. It's not too complicated. It's very, very easy to understand, and I love it because of how simple it is, right? Now a three labeled as a three, a bar that took out the previous bar high and previous bar's low. That's this candle's volatility. This candle pretty much it describes volatility in a nutshell. It breaks above and below the previous candle. So this candle, current candle right here, breaks below and above. Both sides are broken. This is a period of volatility. So this period we'll see higher highs and we'll see lower lows. So when identifying candles, we use the highs and lows. Do not ignore the wicks. I've seen some people, they're sending me candles and like, is this a 2 bar? And it's a 3 because it broke both sides. And they're like, well, that's a wick. The wick matters. Absolutely will be mattered, right? A 3 cannot occur without being a 2 first. For a candle to turn into a 3, it has to be a 2. Before it turns into 3, it has to break one side for it to break the other, right? Once a 3, always a 3, and it cannot be undone, right? So once a candle breaks both sides, it can just unbreak the other side. It can't break the previous. For example, it broke the highs, then it broke the lows. Now it can't unbreak the lows. That's pretty much it. It broke the lows, right? So that's that. This breaks both sides. For the people that are wondering, will it be recorded? Yes, it will be recorded. This will be recorded and will be posted on YouTube. Again, Z, I'll go ahead and ask you a couple questions about the inside bars and ones and twos and threes. What is your favorite and why do you like to trade it? Not fill to ups, just ones and twos and threes.
Ones and twos and threes. Honestly, the inside bar out of those is just my favorite. Honestly, since I do love personally trading reversals than continuations. I
Okay.
personally kind of have I won't say never taken like a 2-2 continuation because really I'm not like a continuation kind of trader. I rather I have a higher win rate with reversals rather than continuations. So I just personally like inside bars and breakouts that's normally give us a reversal. And sometimes it does give us the continuation, yes. And but usually I do take them on a reversal, and I also love the threes. I mean, love the threes if they're with me. Not the threes. I mean the mother bar basically. Obviously inside bar there is has to be a mother bar behind it. If it breaks that, it confirms that direction. So I do love the inside bar. I use it mostly and around like resistance areas like supply and demand zones basically.
Okay. To me personally, I like to trade trending twos. I like direction being picked before anything. I'm big on just trading a continuation. I like trading continuations. I like to wait and let the play kind of develop. By that time, whenever it's time for me to get into a trade, I am into basically continuing that direction. So I like to trade continuations at the same time inside bars. That's something I'm interested in. I like inside bars because they pretty much give me a consolidation period and then we expect a breakout. So we've seen that happen a couple times last week, throughout the week when we traded gold live with you guys on TikTok or here on Discord as well, where we take inside bar trades. Love them. They're amazing, right? Just like Z mentioned, reversals are there and continuations are there. Both are awesome. Both are very solid and easy to catch with the strat, right? Now, why are ones and twos and threes important? A lot of people are probably wondering. Again, I'll explain everything, so just give me some time, guys. Ones, twos, and threes are the only thing that could occur within any given market when using a candlestick chart. Again, using a candlestick chart. Now, using a line chart or whatever else, that's not what we're doing with the strat. It's pretty much just ones and twos and threes and candlesticks because they're not lagging. We don't have to worry about anything else, right? So that's what it is. Knowing that there are only three outcomes from one bar to the next to the next statistically means that there is a finite amount of candlesticks that can occur from one bar to the next. Therefore, we do not have to guess where price is going. It will tell us exactly that in real time as it occurs. So, what does that mean? If we see a 2 bar or a, for example, trending twos, and we see a break of a two up again, what do we expect from price to do? Continuing the twos up, continuing in that direction. If we see that, for example, price is going to give us a inside bar, then we could expect a consolidation period, and a break of that consolidation period could be a breakout or could be just a break and a retest. A lot of people trade it that way too. So just those are things that we look at, and that's the way we use them. Okay. Now, that's why it's important. So reversals. This is what Z just mentioned right now, which is what I was going to ask him next after we go ahead and explain this. So price can reverse in so many ways, right? We all know that. We've seen where prices, people like taking trades, like Z, the one he just posted right now on the Discord, right now on the chat. He took a trade of a reversal. That's a reversal right there. Price can obviously come down to levels, and then from there it could reverse. Now, what are reversals? A reversal is exactly what it sounds like, a point where price stops going down and begins going up, or stops going up and begins going down. The strats gives us a unique view on reversals since we understand that there is a finite amount of them. We then understand exactly what they look like. So, in a scenario over here where we see a two down, for example, or a very, very bullish candle that's still a two down, this is still a two down. It still broke to the downside, but not to the top side, right, from the previous candle. Giving us an inside bar, then breaks the inside bar to the top side. That is our reversal. Boom. It's that simple. This is what we call a 2-1-2 rev strat or reversal, right? So that's one, right? Now, inside bar reversals. Inside bar reversals are one of the easiest to trade. This is because they are so simple to scan for and recognize and just notice and see. When looking to trade inside bar reversals, all you have to do is scan for an inside bar. There is a inside bar, scan. I will go ahead and explain that scanner. This is on Thinkorswim for scanners. For anybody that's using TOS, you guys can link that, and that's the way to scan. Pretty simple. But what those look like, I mean, if you're trading in QES and GC, they're just three different charts. You could easily find those on multiple time frames by just looking at the candlesticks, and you could spot those hands on. I don't use a scanner personally unless I trade options. Sometimes I use a scanner, sometimes I don't. But futures, I've never had to use a scanner. I know a lot of people in here are using futures to trade, so you guys don't need a scanner. If you want one, I could provide one with a link from, again, for Thinkorswim. It's just pretty much a plugin that you add, and that's it. Now, for example, a 2-1-2 reversal, a 2 up for in a scenario where a candle is pushing a 2 up and then it gives you an inside bar. That inside bar gives you the entry for a continuation play or reversal. In a case of a reversal, candle breaks to the downside, that's your entry trigger, and then pushing a 2 down, this is your target to come back down to these lows. A lot of people are going to say this looks something like the CRT. Actually, CRT was copied by the strat. So the guy that actually came up with CRT, he copied it from the strat and he rebranded it and he sold it as an ICT concept. Just for the people that don't know. Same thing that happens here. For example, we're pushing in a bearish trend. We form an inside bar, break of a 2 up, and then continuation. If I'm not mistaken, Z, you took up an inside bar, right? Yeah. If you got,
Yeah,
oh no no. Well, yeah, you guys can
on
see
the
actually on
30,
Z's. Yeah. Look at
on the
Z's
30 minute.
trade right now. You guys can see the one that he took. He took a pretty much inside bar, break of a 2 up, entries, stops below that zone, and then he targeted that previous zone up top.
Hmm.
Pretty simple. These are different examples of what inside bar reversals can look like, and that's pretty much in a nutshell what it is. Now, a 2-2 reversal. A normal 2-2 reversal is going to be harder to find and trade slowly because it is a 2 candle pattern. It's kind of annoying. I stay away from it personally, but again, if it's a fail 2 up, if it's a fail 2 down, that's something I'm interested in and I'll trade. Now, when looking to trade 2-2 reversals, you want to look at the candles. You want to look for the candles that are 2 up, took the previous high, and red, or 2 down, took the previous candle's low, but green. Now that means it's a failed directional move. That's what we come and talk about, failed 2 ups and failed 2 downs. This is the case because we know an entry into a 2-2 reversal to the upside is the previous bar's high. So if we close green, we will be more than likely to reverse as we are closer to that candle's high, and vice versa for a 2-2 reversal to the downside. What does that mean? No, I'm throwing a bunch of terms, so I know it's complicated. I'm going to explain that. So, Z, you want to explain fail 2 ups, fail 2 downs for them in these two scenarios right here? There's a fail 2 down and a fail 2 up right here.
Well, let's put it as simple as it's as simple as it sounds. We failed to continue in one direction. So failed two up is basically a candle that broke a two to the top side and then failed that direction by closing underneath the previous candle that it broke out of it. And it gave us, for example, a shooter. But in that sense, it shows like there, I mean, it's still a failed two up right there, and it broke to the downside, so that could be your confirmation for that trade. You take your trade right there, you put your stop loss above that fail to up, for example, and you target the previous candle. And you just target that. That is your TP. A fail to down is the same thing right there. We failed to go lower, so it gave you a wick, and from there it closed in the previous candle. It broke it to the top side right there, and your target, that's your entry, that's your execution, your stop loss underneath the two, and then your target is right there. It's as simple as it looks, and it's as simple as it sounds. It's just, it's, you could say it's a common sense thing of oh, it's a failed to up. We failed that direction to go to the top side, and then we're basically, what's gonna happen next is we're gonna, if we break it, we're gonna continue that trend down. And the opposite is the same thing. Fail to down is the same thing as fail to up. So these are kind of indicators um of like a, for example, a reversal. These are indicators
Reversal.
for the
Yeah.
reversal. But you gotta know obviously when to take those. You can't just take them at a random zone or inside, like in the middle of where we trading, in the middle of where we trading, or um, like in the middle of, let's say, low day or higher day. You can't just take a trade right there because it's gonna be obviously a lower RR, and you're trying to target a bigger RR a little bit, stay in that trade a little bit less riskier on you.
Yeah. So, in my explanation of it is what I've been mentioning on live with you guys on TikTok and on Discord. It's a V shape, is what I look at it. So, think about price doing this pretty much, right? So, it's moving down and then it bounces right off of that level or at a certain price point. It just bounces off of that, comes back into that range, and then closes here. So it comes to me as this is gonna be my point of interest. This is where exactly I'm looking for price to come to next. Again, I'll explain my approach about these here in just a second because I don't follow the strat entries on the dot. I use my own entry models, etc. But this is to explain the strat in a nutshell for people that are new. You could follow these entries to for a better confirmation and to kind of have a better system than you coming in and trying to follow my system because it's gonna give you a hard time. I'm gonna have to explain it even deeper. To explain how I use these as an entry point for me, this is the V shape that I look for. My entry is going to be off of the pullback that we have on the next candle to go ahead and push that high. So what that would look like is this push down right over here. Then we have that failed to up scenario. Then we have that pullback. So this is the V shape right over here. Then we have that pullback. We do not break below the slow. And then we have that instant follow through to push back up to the highs. So this is kind of what I'm looking at. This is where my stop loss will go. This is where my entries would go if I miss this entry right here. So if I don't feel confident in taking an entry here, I will wait for a break. That's what I've been doing on gold on the 5 minutes with you guys on live on TikTok is I'll be waiting for a break off the 5 minute for me to take entries. I will not take a trade unless that happens, right? Now, vice versa for the longs, right? Going from the longs, pretty much we have a push down, or sorry, a push up. Price is pushing up. Then we have that V shape, which is right over here. So this is our V shape. We're going to get the next candle is going to give us the pullback as it's creating the top wick to push back down. And this is my entry right here. So my stops will go above. My entry point will go somewhere in here. This is a confirmation for maybe another entry and then TP, etc. Right? So someone that is coming in, I've noticed somebody said something by ICT. Someone that's coming in with previous technical analysis and previous experience with the market is going to definitely find this harder to understand because we do the complete opposite of what other technical analysis do. We do a lot of different styles of trading. We do a lot more different things than they do, and that's why we make more money than they do, to explain that in a nutshell, in the most humble way. 322 reversals. A 322 reversal is going to be easier to scan for as it is a 3 candle pattern, meaning we can scan for the first 2 and trade the third, right? So when looking to trade 322 reversals, you want to trade them the exact same way as a normal 2-2 continuation or 2-2 play, pretty much. The way we look at that is a 3-bar forms out. When a 3-bar forms out, it's going to give you a setup on the next candle. It is either going to be an inside bar One, two, a fail two up or a fail two down. Majority of the time, majority of the time, it's going to do that, right? So what we have here in this scenario is a hammer candle. What we have in this scenario is a shooter candle. Z, our favorite entries right here, so you could go ahead and explain them. I'll let you do that, bro.
Hammers, same thing. Failed to up hammers after a 3 bar. We failed that door. Right? Giving a 3 bar is basically we push with volume to the top side and push to the downside, but still hasn't. We're still confused on what kind of direction we're picking or we're going with, especially if we have a failed to up or a failed to down. For example, in that hammer case right there, we have a failed to down and it gave us our entry right there. It closed inside the previous candle and it gave us our entry. As it broke to the top side, the next target is going to be that 3 bar right there, giving us kind of the same thing, the V shape, you could say, around that. And it's basically a hammer right there. You take your executions there, you put your stop loss underneath the candle, and you let it ride out all the way to the target. Same thing with a fail to up. It's giving you the same thing. 3 bar, we failed. It broke to the top side. It failed that direction. It closed inside the previous candle, which is the 3 bar, and it gave us our entry. And the target for us full TP is gonna be at the 3 bar. That that's the next target is to be at that 3 bar low, and basically it's as simple as that.
It's very, very simple. And again, a lot of people would notice this and probably catch this using the what's it called, the CRT model that has been coming out recently a lot. I actually have no problem against the CRT. I think it's really good because it's pretty much the strat. Like I learned the strat a long time ago, and when I saw the CRT, I was like, oh, it's just the same thing as the strat. This is awesome, right? So for me, that's pretty much good. The thing that I want people to understand is that since we're recording this, higher time frame wins. Higher time frame. Lower time frame is good, but what matters to me the most is you finding the setups on the higher time frames, not on lower time frames. And that's where we go into execution a little bit deeper, and we'll explain that. But higher time frames is what matters to me the most, right? That's what matters to me the most. A This scenario right here where it forms a hammer is pretty much a bull flag, or what we call it just a hammer because the candle looks like a hammer. Ta-da, right? Cool. Now a 3 bar is a candle of volatility. Then we have a hammer or a failed two down. Then we have that two up. We break off the high. We put our stops below entry. This gives you a very solid RR multiple. When you're taking these setups right here and it does play out, it usually plays out with very good momentum, barely any drawdown, and continues in your favor for a long time, right? No, you do not take entries off of the 3 bar. You do not wait for a 3 bar to happen. If it happens, then you gotta hold off actually. For me, I'm big on avoiding trading 3 bars. I hate, and hate is a strong word, but I hate trading 3 bars. I genuinely do not like 3 bars. I'm not into it. I'm just so against it. Because volatility, it's taking out the highs and the lows. At that point, there is no sense of direction. And I like direction. I like price when trending. It's in one direction. That's why I was able to catch my 200, 300. Even one time it went to 1,000 something points. What we took in during Discord on New York session. So when we're catching these plays that are huge and big, amazing plays, it's because there is a sense of direction in the market. And that's what matters to me. Once it's a 3 bar, I would want to exit, trim, or anything like that, right? I would do it immediately. If, for example, price is in my direction and I'm up 50 points, next thing I know is that it's a 3 bar. At this point, I am trimming majority. I'm only in runners. I'm not leaving anything for the market to take back. I'm going to play passive. I'm a very passive player. Z has a different approach on that. He's more of an aggressive player. I'm very passive. I like to get my amount and I'm out. So that's what I like. But if I'm finding, for example, 3-2-2 reversals, awesome. 3-1-2 reversals, awesome. Those are very solid. Those are very good. Now, the rev strat. A rev strat is a consolidation followed by an outside bar or a compound outside bar. This is shown by the highlighted boxes and the results broadening formations. We'll touch more on this later. Right? When looking to trade a rev strat, there are two types. A bar 1, which is I'll say a 1, which is the rev strat 1-3, and a normal rev strat, which is a 1-2-2. The latter is easier to scan for, is a 3 bar setup, while contrast the 1-3 is a 2 bar setup. Now, what does that mean? So, for example, over here on a lower time frame, what we'll see is, for example, this is a highlighted section. So, for example, this is a 3 bar. We have an inside bar, then we have a 2 in a scenario where price pushed down. And this whole thing, if we take this candle where it pushed to 2 down, right? And this candle where it pushed a 2 up and it came past this high point right here, we take these two into combination. What do we get? We get a 3 bar on the higher time frame. So what we'll see is these two over here is what's giving us the inside bar, which is right over here on the higher time frames, right over here, by the way. And for the lower time frames, it will be a inside bar again, followed by 2 down, reversal, ref strat. So what we would see over here on the higher time frames is that it's a 3 bar. It breaks both the bottom and the top, right? Vice versa happening here, same thing pretty much, just reversed. So what we'll see on the lower time frames is that it's a inside bar or a 2 down, for example, then followed by an inside bar, followed by a candle that takes out the highs, fails that high, and gives us a setup to push a 2 down to take out the low. These two in combination give us a 3 bar. Z, do you have anything you want to say about this?
Uh, Not really. I mean, this is a bit of, you could say, of an advanced level of looking at the charts, but it will come to you when you start understanding the one and two and threes. We've been seeing a little bit of this with gold, especially on the higher time frames, like the 30 minute. I have noticed, been noticing it a lot. It's happening, and yeah, this will come to you when you start learning what a one and two and threes. Um, but just don't overwhelm yourself with like everything right away, right? You know, with
Right
everything.
on
Just
the
take
jump,
it
yeah.
slow.
Yeah. Now, continuations. This is my personal favorite because price can only continue in so many ways. I love continuations. I genuinely enjoy it because it's so simple, right? So, what are continuations? A continuation is when price moves in one direction, consolidates inside bar, for example, then continues the move. Trading continuations is best done when playing with stocks that have a higher volatility. For example, Apple, Nvidia, Tesla, Microsoft. Those are always going to be playing continuations. Always look to take the reversals instead of continuations when trading because reversals have a higher chance of working, right? The reversals are actually they happen, they give you even more room for RR multiple. So in a continuation play, you might secure a 1-to-1 RR. But in a reversal situation, you would be securing more because you're catching a move back to a certain level or you're catching a reversal in that nutshell, right? When trading reversals, there are participants that are caught short or long that have to close their position when price reverses against them. And that's what we call trapped buyers or trapped sellers. Because of this, you'll be buying more or you'll have more buying or selling pressure in that direction of your trade. So that's why when selling again, when you're going in that direction and price is pushing, for example, up, it came up to a supply zone, and now we're expecting price to go ahead and start reversing. Now that it starts reversing, we will take that and pretty much use that as a hey, we have trapped buyers here. We're going to take advantage of them. We're going to go against them, right? So when compared to continuations, there is simply a consolidation, meaning those who were long or short previously have no reason to enter or exit. This means that there will be less buyers or sellers to push price or to push trade in your direction. We'll build on this further, a little bit more down as we go on. So not this video, maybe the next one. I'll explain that more in a nutshell. But 2-1-2 continuations. A 2-1-2 continuation looks very similar to the 2-1-2 reversal, but the first two is in the direction that the second two breaks to. When looking to trade 2-1-2 continuations, there is something called a measured move, which is where you want to measure the high and the low of the first two, and then project it from your entry, as an example shown right here. Now the example of that is pretty much right here. So we have this 2 up right here, and then we have this inside bar where it broke the inside bar. We have our first target, and this is our first target. So the thing that I don't like about it, excuse me, I just had to drink some water. But the thing that I don't like about taking 2-1-2 continuations, or that the only downside to it, is that the RR multiple is so tight, right? So you're going to be trimmed out immediately, pretty much so quick, right? So you're in the trade right here. This is your entry. This is your first initial entry right here. Then you automatically get the first target, which is the previous candle's high. Once the candle's high is taken, you want to measure the previous candle's low and high, and you want to go ahead and take that from your entry and have the same measure move. For the people that don't know, that TradingView or Top Step, they have literally a measure tool. They have a measure tool. You could just drag and go ahead and measure this move. If this is a 50-point candle, then from your entry, which is right over here, you're expecting a 50-point move. And it's as simple as that, right? That's what I like about them. But again, it's expecting. Now, is it likely that buyers will continue holding up pressure and continue buying? Obviously, depending on the context of the trade, but more than likely, no. More than likely, no. Especially in this market that we've been trading recently, it's been so hectic. It's been so hectic with buyers and sellers that it's been more of a move up and followed by a move back down to the same lows, and then move back up to the same highs, then move back down to the lows, and then breaking those lows, then moving back up to those highs, and then breaking those highs. It's been such a volatile, crazy market because of the Trump tariff news, etc., that we're having left and right, and just market in general, right? So your entry would be here. Stop loss would go right below the candle. It just broke off the inside bar. You do not want to place it pretty much below the inside. That's too much room. So you place your entry right over here. Your stop loss would go right over here. This would immediately give you about a 1-to-1 RR. This should give you about a 1-to-1 RR. And the rest should be at least a 1-to-3, 1-to-2.5, even more, right? Now, 2-to-2 continuations. These are not actionable signals, but they do occur very often. And this is my favorite when I'm in a trade. I love this because when I'm in a trade, it's going in my direction. What a 2-2 bearish trend would look like is pretty much just that in a nutshell. It's when price is coming and doing this. And in this scenario right over here, what we'll see, this is on the higher time frames. For example, the hourly, the 30-minute, the 15 minutes, even the 4-hour. We're seeing just compounding twos. In a nutshell, what that looks like is this. That's it. So that's the first two, that's the second two, that's the third two, and that's the fourth two. In a nutshell, that's what it is, right? Now, a 2-2-2 continuation and an uptrend, pretty much again the same thing. We have price 2, 2, 2. In a nutshell, that's what it is. And that's exactly what we'll be capitalizing on, right? So that's exactly what we're going to be seeing when we're in a trade. So this is something to not trade off of, to not take trades off of, but it's what you want to see when you take entries. This is the best, right? There's no point of confirmation for you to take a 2-2 continuation play. It's just, to me, I would avoid it. I would not look to trade those. That's not the highest quality. Either you play a reversal strategy or you play a continuation play off of a bounce off of a certain level. So if we go into a supply zone or a demand zone, we form an inside bar and we go ahead and break it to whichever direction that price is going to. In this scenario, let's just say supply. Price is coming up. Let me draw that out. That way I can explain that in the video as well. So let's just say this is a supply zone right over here. So price is rallying up and then it comes up to that supply zone. Over here forms your inside bar. From that inside bar, breaks it to downside. Now we want to go ahead and target the opposing demand zone that is down here, right? Boom. And that's the idea behind it. Or if you're playing a continuation play, so what you'll do is instead of taking that supply zone entry, which is what I've done multiple times as well on live with you guys. So boom, it comes up to that supply zone. Over here, it already starts giving us that rejection, then forms another inside bar over here. Over here, there's another inside. That is the entry that I'll go ahead and take to continue that direction move. This is what continuation looks like too. And that's fine, right? All right. Let's go ahead and move on to the next presentation. All right, cool. Broadening formations. So an introduction to broadening formations. What is broadening formations? A broadening formation is exactly what it sounds like, something that broadens. Pretty much, we used to call it shark mouth too. When trading, we use broadening formations to gauge magnitude, where price is going, because they have to occur in order for price to trade up or down. As previously shown, a 3 candle is by definition a broadening formation because it has made a higher high and a lower low. In a comparison to the previous candle, also as known as broadening the range. An example of broadening formations is shown on the chart, right from SPY monthly chart. So what that looks like is pretty much, we don't believe that price is going to keep going in uptrend when we're trading, whatever. price is going to create higher highs and lower lows. In a very buy and hold portfolio, if you're just buying and holding, obviously your goal is to just hold and that's it. You're capitalizing on the long-term move up and that's it. That's different. But if you're trading, you're looking at lower time frames, for example, the hourly, 4 hour, 1 hour, whatever. This is what you want to be seeing. So price is not going to just keep knifing up and that's it. It's an uptrend. Oh yeah, I'm going to just buy in and wait. Nope, that's hopes and prayers. Because what we believe in is price will take out the highs and also take out the lows. Comes back in, takes out this low, and takes out this high. Then takes out this high again, over here, and takes out the low again. Then takes out that high again, and then takes out that low. We expect it to come back down to take out that low again, right? And how do we draw those? Pretty much look for 3 bars. Look for candles, or 3, right? A 3 bar. Those explain that in a nutshell. It's a lot simpler for people to recognize and see. Z, I'm not sure if you use broadening formations active or very often. Do you?
No, I don't
No,
really do that. No,
I do.
I
I do
don't really
very
look into
sometimes.
it
Yeah.
too much.
What? How come?
Oh. Honestly, it's just from what I have been using, I kind of tried, you could say I tried everything. It's for me, it's like an extra confluence, you could say. If I'm inside a 3 bar, for example, I do mark out the lows and highs of it, and it's just like I don't mark it to show everybody that I'm in it. It's just I see it, I just mark it in my head. I don't have to mark it completely and wait for those levels to be tapped to and expect a move from them. It's just I guess an extra confluence that I put sometimes with um, the strategy or the entry that I take. It's something that I don't use. Um, Same thing with the 2-2 reversal. I don't really use that too because it's riskier. I
Yeah.
try to get away from risky trades as best as I can.
Mm-hmm.
But I mean, and it doesn't sound correct because I do love reversals, but reversals to me is just they're much simpler than continuations. I feel like there is more risk in continuations. That at least that's for me. There's
Yeah.
more risk in continuations rather than reversals.
Yeah. That's the way. So again, just because it's risky for someone, that doesn't mean it's risky for everybody. So just know that like whenever you're trading and you're using any of these strats, patterns, pretty much you want to call them, just kind of test them out and see which ones work the best for you. Because our journey is completely different than everybody else's. We're simply giving you guys the education, and again, you're free to explore whichever one works for you the best. We're not financial advisors, obviously, so we're just sharing what worked for us. Now, in a nutshell, what broadening formation looks like. So this is a 3 bar. Pretty much we know that this is a 3 bar. What we'll see is we'll go ahead and draw the low and the high. When price comes up to the high, we expect price to now reverse back down. And when price takes out the low, we expect price to come back up to take out that high. And that's just the way it is. Eventually, it will create another 3 bar. When it creates another 3 bar, that's when we go ahead and pivot that broadening formations to a newer one, right? So, recognizing and drawing broadening formations. All broadening formations is telling us is that there is a higher high and a lower low. That's it. It's just saying that. There's no different way of explaining it. There's no more difficult way of explaining it. It's just that simple. Literally, just a higher high and a lower low. When drawing a broadening formation, you draw from the front to the back, right to the left, in order to get all of the data possibly. Ideally, it should be a slight lower low and a slight higher high. To add a broadening formation is not saying, oh, we have to go and hit the upper or lower and continue, for example, go back down to that low. All it is saying within that time frame continuity is without the reversal against us, we expect price to go to X price, which is the previous high, basically. So go ahead and explain that more. But I'll go ahead and pause the video here in just a sec. Give me 1 second. But all right, so this is an explanation for the broadening formations. I pretty much just shared with everybody a indicator on the Discord for people to use. If you want access to the indicator, just send me a message on the general chat or anywhere. Just submit a ticket and say, hey, can I get the broadening formations indicator? It's literally there. But what this shows is pretty much on different time frames. So for example, in 30 time frames, this is a 30-minute time frame right here. We'll see that this is the broadening formation we have. We expect price to come down and to take out the slow again. So what we'll see is, where is it? Right over here. Boom, boom. So we'll expect price to come down to here, take out the slow, then eventually come down to take out the slow as well. That's what we expect, right? Same thing vice versa for our longs. If we see a broadening formation for longs, for example, on the lower time frames, that's what we expect price to come take out. So when we see setups, we can anticipate that price will go there. We're not targeting that high, but this is expected for us to wait and sit back and say, okay, well, we're overextended. Once we push this high, we're way overbought. Or when we push this low, we're way oversold. That's the way we look at it, right? So a lot of people use RSI and these different indicators. To us, those are lagging. We don't use them, but that's the way to trade them. Okay, let me pause the video one more time. Since I started recording again just one more time, can you re-explain those one more time, just real quick, the supply and demand zones? Because I just started re-recording again.
Okay.
It's like, just make it a
So,
quick, you know.
okay, marking a supply and demand zone is very simple. You just look for a demand zone, you look at the consolidation or at the bearish candle before the strong move up. For example, that we have right here on this trade, we had this bearish candle right here before the strong move up. I had marked that zone out. We tested that zone. We got a buyer stepping in off that zone, taking that price higher, and the trade went in our direction. For a supply zone, it's kind of the same thing, but you do the opposite basically, which is you mark out before the so the bullish candle before the strong move down, that's where you mark it at, and it's to you wait for us to tap into that zone, and then from there you take your entries. If we get weaker around the zone trading up to that zone, if we get weaker around that area, you try to find for an entry is like a fail to up or an inside bar or some kind of indication for these shorts, and you take them from there to the other demand zone or your other depends if you have an RR multiple or not, um, and that's it basically.
In a nutshell, it's pretty much buy low, sell high. It's not too complicated to pretty much understand and like look at those, because they're pretty like self-explanatory. If you want to look into videos, I mean, there's the best video I would highly recommend is gonna be with anything that has to do with order blocks or anything that has to do with supply and demand. So don't look at the fancy guys that are showing you these like the fancy backgrounds and all these things. Just look for someone that is showing you a plain chart on a YouTube video, and that's it. That's all you need. Those guys are trying to do some weird stuff. That you don't need that, right? And also, for anybody that is interested in supply and demand levels, I found an indicator that is amazing at marking those out, and it is called by Nephew Sam, Order Blocks. It is an amazing, amazing, amazing script that he has. I think I love it, honestly. I love this. I will go ahead and drop the link for it right here to the Discord. Again, anybody that is not in the Discord that wants the indicators link for it, just go ahead and send me a message that is watching on YouTube. And yeah, Z, you want to do the outro real quick before we get into the questions with the Discord?
Thank you guys for watching. This was just one of the first class that we're having here. If we get a lot of positive reaction, we have 240 people watching, which is beautiful and great. It just shows us that there's a lot of people are that want to learn of trading and how we trade and everything. So appreciate you guys for being in here and tuning in, and hopefully we'll with the positive obviously reviews from you guys, we will do these more and
More
record
often,
more
yeah.
videos, and yeah, we'll just show you guys how we trade.
Awesome.
If you
Any
liked it,
yeah,
yeah,
drop a
go
like.
ahead.
If you liked it, drop a like. And if anybody has any questions that you guys want us to follow up on and just do reviews, stuff like that on, just go ahead and drop them in the comments. And if you're in the Discord, just drop them in the general chat, or just send it to me as a message, or just drop it to me in a ticket, and I'll go ahead and do that for you guys. Take care, everybody. See you guys on the next video.